Welcome to this tutorial. I was just looking at this fascinating guide from Mindstock called Beyond Savings Accounts, and we absolutely need to dig into it today. We're going to explore how people are supposedly hitting these AI-driven high yields in 2026 and really decode exactly what's going on behind the scenes. Okay, let's dive right into this. 7% plus. I mean, it's a number that catches everyone's eye, right? It's that elusive target that feels like it could actually make a massive difference in growing your wealth, especially when you start factoring in inflation and just the everyday costs of living. But, well, the reality we have to face right up front is the sheer frustration that everyday savers are feeling right now. Traditional bank accounts simply cannot reach that number anymore, not in 2026, and for sure not without fundamentally changing how we think about our cash. So the absolutely crucial question the guide poses is, what do you actually have to give up to get it? And honestly, this is the core theme of our tutorial today. We need to look at this totally impartially, because here's the truth. There is no magical risk-free return hiding out there in the financial system. Every single strategy we're going to discuss carries a real risk of loss. Yield is something you trade for, right? It's definitely not a free lunch. Let's map out our roadmap for today. First up, we have the cash reality check. Then, rung 1, AI cash management. After that, rung 2, covered call ETFs. Moving on to rung 3, private credit. Then we'll be demystifying the AI marketing and finally building your blended portfolio. The source material lays this out brilliantly. Think of it like a ladder. Notice how, as you move from rung 1 down to rung 3, the typical 2026 yield climbs from roughly 3.3% all the way up to 14% or even more. But as that yield goes up, the liquidity drops off a cliff, from instant access to having your money locked up for months or even years. And the real risk? Well, that escalates from simple interest rate fluctuations to actual default risk. Intuitively, every single step up this ladder means leaving the safety of the ground behind in exchange for those much higher yields. Section 1. The cash reality check. To really understand why we even need this ladder, we have to look at the macroeconomic environment of 2026. Following those 3-quarter-point rate cuts we saw back in 2025, the Federal Reserve has held its benchmark completely steady between 3.50 and 3.75%. Because of this, traditional high-yield savings accounts have hit a hard ceiling, pretty much capping out around 4 to 4.5%. You can probably feel the impact of those cuts on your own bank statements, right? The easy money era of just parking cash for a guaranteed 5.5% is totally over. So what this means is that it's mathematically impossible to reach a 7% yield today without trading away something vital. Whether that's principal safety, same-day liquidity, or tax efficiency, something's gotta give. Section 2, Rung 1, AI Cash Management. Looking at Rung 1, we're sitting at a 3.3 to 4.5% yield. Okay, it's not blowing the roof off, but it is safe. The source material is very clear about this. This base layer of the risk ladder is exactly where your emergency funds belong. Robo-advisors like Wealthfront and Betterment operate right here. They use automated sweep logic to constantly move your deposit to whichever partner bank is paying the most on any given day. And it's pretty wild. By spreading those deposits across multiple partner banks, they can actually extend your FDIC insurance up to $8 million. That is a lot of safety. But remember that core question we asked earlier? What are we trading away? Well, here you keep your instant access and you avoid market risk entirely. The catch? Your money just isn't working as aggressively for you. The trade-off that really matters is simply that your yield is strictly capped below 5%. You are perfectly safe, for sure, but you are giving up that extra growth potential. Section 3. Rung 2, Covered Call ETFs. Now, if you want to clear that 7% hurdle, this is the most accessible way to do it on the public stock exchanges. And wow, look at that jump, 8 to 14%. So how on earth are they doing this? Well, it turns out funds like JEPI, which tracks the S&P 500, JEPQ for the NASDAQ, and newer funds like QQQI are doing something really interesting. They hold a portfolio of stocks and systematically sell or write call options against them every single month. Think of selling a call option kind of like renting out the potential upside of your house. You collect a premium up front for agreeing to sell at a certain price later. That premium collected from selling those options is exactly what gets distributed to shareholders as monthly income, generating those real 2026 yields. So the crucial point here is balancing the pros and cons on this rung. You absolutely get daily liquidity because these trade just like normal ETFs. But man, the trade-offs are significant. First off, your upside is capped. When the market has massive rally days, you miss out because you essentially sold that upside away. Second, your principal can still drop if the underlying stocks fall. And third, and honestly this is a big one, most of these distributions are taxed as ordinary income, not qualified dividends. Depending on your personal tax bracket, that can take a massive bite out of your actual net yield.
Section 4. Rung 3. Private credit.
All right, this is the most aggressive rung on our ladder. We are talking about institutional-style lending. Historically, this meant massive, multi-million-dollar loans to private mid-sized companies, entirely orchestrated by Wall Street banks and private equity firms. But now, it's accessible to everyday retail investors on platforms like Percent, Yield Street, and Fundrise. The numbers here get very, very enticing, 9 to 14% or even more. For example, the platform Percent reported a trailing 12-month net return of roughly 13.7% into early 2026. But, as the playbook explicitly states, and we absolutely must echo this impartially, past performance guarantees absolutely nothing.
So it's time for a sober reality check. You are getting those institutional yields, but industry-wide private credit defaults were actually running an estimated 3 to 5% in early 2026. Your capital is locked up for months, sometimes literally years, meaning you can't just hit a sell button if you suddenly need cash. And absolutely none of this money is government insured. If a borrower defaults, it directly reduces your return. No safety net there.
Section 5. Demystifying the AI marketing. Let's be honest for a second. AI is literally slapped on everything these days. But the guide is very clear on how we define AI-driven here. It is an efficiency engine, not a magic shield against risk. On rung 1, it's just automating sweep logic to find the best bank rate. On rung 2, a systematic model replaces human options desks to perfectly time strikes. And on rung 3, it scores thousands of private loans simultaneously. Basically, it just makes the process faster. While AI might be an absolute math genius, it hasn't somehow learned to magically erase structural financial risk. The playbook specifically warns us to be highly skeptical of any pitch claiming, "Our AI finds you 7% safely." The AI creates efficiency, sure. It absolutely does not eliminate the structural risk required to actually generate that yield.
Section 6. Building your blended portfolio.
Just as a quick reminder, this tutorial is an educational illustration based on the source text, definitely not personalized financial advice. But notice how a theoretical investor might slice up their capital to mix these rungs based on their personal liquidity timelines. You'd see a slice for rung 1, ensuring 3 to 6 months of expenses are held in perfectly safe liquid cash. Then a slice in rung 2 for measured exposure to higher-yielding monthly ETF income that you could easily sell if your plans change. And finally, a much smaller slice for rung 3, the long-term locked capital that you genuinely do not need to touch for years, aiming for that double-digit yield.
To actually do this without getting burned, the guide gives us key rules focusing on those vital, unheadlined risks. First, know your exact liquidity timeline before picking a rung, because a sudden need for cash in a locked-up private credit fund can be completely disastrous. Second, really understand how your tax bracket impacts that headline number, since ordinary income taxes can quickly churn an 8% yield into a 5% net return. Third, move in gradually so you aren't locking in a single day's price or interest rate. That really helps smooth out market volatility over time. And most importantly, never ever put money you might need tomorrow into rungs 2 or 3. Just don't do it.
We're going to leave you with this golden rule directly from the playbook. Yield is a trade, not a trick. Seriously, let that sink in for a second. Earning 7% or more in 2026 means making a deliberate, clear-eyed trade with your money. You are always trading safety, liquidity, or tax efficiency in exchange for that higher return. So I want to end this tutorial by challenging you with this final, provocative question. What is your exact financial timeline, and exactly how much safety are you willing to trade for yield? It's a question only you can answer, and I highly encourage you to speak with a licensed professional before chasing any headline number. Thanks so much for joining me on this exploration of the risk ladder.